But we haven't seen a gain like that, I think, in a single day since 2008. But we'll have to talk to our stats master, Jared Blickery, about that in a moment. And that is the closing bell on Wall Street. And now it is market domination overtime. Jared Blickery is going to be along in a moment to give us some more details from today's session. But let's start with those major averages and just the incredible session that we have had and turnaround that we saw today after the announcement from President Trump that there would be a pause for 90 days on the highest tariffs on most countries. A couple of exceptions here. China's tariff is actually going to go up to 125%. The baseline tariff for most other nations will be 10%, and there are still 25% tariffs on Canada and Mexico. We're going to get more details on all of that in a few moments from our Ben Werschel. But if you look at the numbers here, Dow rising by more than 2,900 points. That's good for a gain of 8%. The S&P 500 up 9.5%, and the Nasdaq Composite finishing the day higher by 12% here. Jared Blickery at the Nasdaq's got a closer look at today's action, the remarkable action that we saw today. Hey, Jared.
Thank you, Julie. It's just been incredible. Yes, I was actually here just a little bit ago taping a Stocks in Translation episode with Sydney, and we got to walk around and talk to some of the traders. Just absolute frenetic action right now. A couple interesting stats. The S&P 500 and the Nasdaq 100 had their best day since October of 2008. Nasdaq Composite, by the way, had its best date since 2001. And let's go to the Wi-Fi Interactive so we can chart some of the heat maps here. If we got a little time, I'll even get into the VIX, which is now in the 30s. It was at a 60 just days ago. Here we're looking at the sector action. XLK, that's tech, that is up 13.4%. XLY is consumer discretionary, where we have Amazon and Tesla. This is the best day ever for that ETF, going back to January of 1999. That was inception. Even utilities, which is a laggard of the group, and staples only up 3.8%. Healthcare up 4%. But let's go to the Nasdaq 100, where we can see some of the names that have just gotten so much heat and so much beating down this year are just flying right now. Apple up 15%, Microsoft up 10%, Nvidia up almost 19%, Meta up about 15%, Alphabet 10%, Amazon 12%, Tesla 23%. And let's just put some of this in context. I'll show you a one-year chart so you can see Tesla recently got cut in half, and now it's making its way back up. You can see it's still got a long ways to go here, but a really interesting start. I'll also chart some Apple for you. This is 1 year as well, and you can see a bit of a nice rise off of those levels that we're seeing. And I just want to point out something in the S&P 500. Let's go to the year-to-date chart. We have now surged right back to this area where we just fell off a cliff, and it's going to be really interesting to see if we get in this area, what do traders do? A lot of traders were buying the dip in there. A lot of those traders are going to want to sell to break even, and so we do need more positive catalysts to break beyond this price level. But a really interesting start here. And also, I want to check in on the VIX real quickly, because the VIX is now at 33. I said it was at 60 just a few days ago. These are closing prices only, but this is getting back into somewhat normal territory, and this just provides a very good institutional look at who's hedging, and these are the big players that are hedging in the VIX, in the S&P 500. We can also take a look at the bond market volatility. That is incredibly elevated as well. And to close here, I'll just go back through some heat maps. I want to check in on the semiconductors, because those have been led by Nvidia. Nvidia, just a kahuna, up, as I said, almost 20% there. AMD over here, that is up 24%. Texas Instruments, a slower mover, that's up 16%. Intel almost up 20% as well. And let's check in on the ARC Innovation components. Aside from Tesla here, and I'm going to sort by performance, you can see Robinhood up 23%, Unity up 19%, Shopify up 19%. So across the board, we're just seeing a lot of risk on action today. Haven't seen many red squares, and I guess I'll close on the Dow here. No red to be seen. The laggard, J&J, seems to be up about almost half a point. But just to recap, a lot of surprises today, and a very bullish end to this frenetic action.
That sure was, Jared. All right, U.S. bonds are generally seen as a safe haven for investors, but Wall Street's bumpy ride amid tariff turbulence may be posing a big problem. For more insight, we are joined now by Manulife John Hancock Investments Co-Chief Investment Strategist. That would be Emily Rowland to help break down all we saw in today's action. Emily, I want to start by just asking you, Emily, listen, you are, of course, a longtime student of these markets, Emily. So you saw these headlines, the Trump tariff pause, the Trump tariff reversal. This popular averages surged today, Emily, off that. Just curious what you make of all of it.
Yeah, I mean, these moves were just absolutely breathtaking today. We were actually right in the middle of our quarterly call with the advisors that we work closely with as things were moving quickly here. And it looks like the Trump put seems to be alive and well here as it relates to markets. I think one of the most notable things you just pointed out, which is the technology sector seeing outsized gains today. One of the things we've been talking about in terms of the cross-asset action related to tariffs is that some of the highest quality parts of the market are the ones that have gotten sold off the most. Obviously, there was a bit of a valuation issue with the tech space, but these are still the companies with the best balance sheets, the highest quality earnings, best return on equity. And we really saw them being sort of the baby that was thrown out with the bathwater. Meanwhile, areas like German industrials, European banks, Chinese tech stocks were the relative winners here. And that cross-asset performance didn't really make a ton of sense to us. So nice to see tech seeing a very, very healthy bounce today.
I don't know, Emily. Listen, I know you can't talk individual stocks, but I look at a stock like Apple, which makes most of the iPhones in China.
Yeah.
The tariff on China is now 125%. And Apple went up a lot today. So, okay, I won't ask you to comment on that specifically, but is this really, do the moves in the markets make sense?
Yeah, I mean, Julie, great point. And there's probably some indiscriminate buying today, just the way that there was some indiscriminate selling. So it's going to take some time here for the dust to settle. We're waiting to hear more in terms of the fundamentals and what analysts say about, forward guidance here as it relates to earnings. But, I think as the days progress and potentially there's less volatility around tariff headlines and a focus on the fundamentals, a focus on earnings, we can see sort of where, individual names sort of, settle out here. So time will tell, I think, but on a relative basis, I think finding opportunities within the technology space, does make some sense here.
Emily, all the volatility that we've seen, dramatic volatility, the uncertainty, the drama, did that cause you, Emily, were you making any changes to your investment outlook strategy to how you wanted to be allocated?
So we try to minimize politics as an input into making investment decisions, which I know sounds almost ridiculous this year, given the amount of geopolitical uncertainty that we've seen. So we did, though, make some changes unrelated to the political backdrop. In fact, this quarter, coming into the quarter, we took our overweight from U.S. large cap stocks down to neutral, not selling, but just going to neutral there, just given the valuation extension that we'd seen. We saw back-to-back 25+% returns on the S&P 500 in 2023 and 2024. And we started the year at 22 times forward earnings on the S&P 500. We also saw analysts penciling in nearly 15% earnings growth on top of already solid earnings growth last year. So we just felt like the starting point was a bit tricky on U.S. large cap stocks. And we actually allocated that to bonds. So we went into the credit markets just as a way of reducing risk, high yield bonds, yielding close to 8%, even with some spread widening here, which obviously we've seen over the last week or so. We felt like the income there was attractive enough to overcome that. So taking some off the table in U.S. large caps, allocating to high yield bonds, and actually being the most overweight fixed income that we've been in really the 10 years that we've been putting our outlook together.
I want to talk about bonds. Linger there for just a minute. You and I have been talking about bonds for a while, I believe, and you guys were early on that moving into bonds. But we have seen, and I know that you're not in necessarily treasuries per se, you're in other areas of the fixed income market as well. But what do you make of that move that we have seen over the past few days, the move higher in yields that has really confounded a lot of investors? And by the way, the 10-year yield is still higher today, even after everything else reversed. Where do you think that goes from here?
Yeah, one thing we're not too happy about today is we haven't seen Treasury bond yields move meaningfully lower, and that's really been our biggest concern over the past couple of days. We've seen a number of different dynamics at play. The unwind of the highly leveraged basis trade. We've seen some concerns about liquidity, even thoughts that the Fed would need to jump in to provide more liquidity to the market. In addition to this narrative that China and other overseas holders of treasuries might flood the market, dump all their treasuries, causing bond yields to rise. So there's been a number of different sort of fears out there that I think have spooked bond investors. Our view here is that if there is a flight for quality, investors are going to buy 10-year treasury yields. And if, China, for example, did want to sell, what would they buy? Japanese bond yields are around 1% right now. Even China bonds are yielding less than 2%. So the US still has the best yields around the globe right now. It's still higher quality. And I think if we do see, a flight to safety, ultimately bonds see a bid here. So a little bit concerned about those elevated yields, but I think in time we see them drift lower, and we'll learn more about the inflation dynamics as well. I think everybody's maybe forgotten we have a CPI report tomorrow, but that'll be really important for markets to digest as well.
Yes, good reminder, Emily. Thank you. Good to see you.
You too.
Well, President Trump stunned markets today by announcing a 90-day pause on his reciprocal tariff plan. But it wasn't just investors caught off guard. Joining us now with more, Yahoo Finance's Ben Werschel. And I guess what we saw once again today from this administration is they're not all singing from the same hymnal, Ben.
Right, exactly. So we do have a little clarity on exactly what the duties the change that was being made into there. I'll just, from a White House official, we do know a couple of details that I know are important for sectors. That the EU tariffs are coming down. So the EU, even though they've announced retaliatory plans, are lowering from a 20% to 10%. Also, Section 232 tariffs on steel, aluminum, and autos are staying in place. And Canada and Mexico tariffs are unchanged. This comes as Trump has raised tariffs on China to 125%, but for the rest of the world has removed reciprocal duties for now, creating a floor of baseline. But as you mentioned, that's the kind of what that we know. The why is we're getting some mixed messages this afternoon. Trump just in the last hour talked about how he did this because, quote, they were getting a little bit yippy. They were getting a little bit afraid, talking about both the stock market and the bond market. Clearly a reaction to some of the turmoil we've seen and in sort of the lack of clarity on exactly what move he was making. He also said that he would consider company specific exceptions, quote, instinctively, it was his word. This comes after Treasury Secretary Scott Bessent just an hour before had talked about how this was the plan all along. So it's a sort of fast moving story. We do have a little clarity on exactly what he's doing, but it's going to take some more reporting to get exactly what changed the move from the White House this afternoon.
Yeah, exactly. When President Trump talked about panicking, he said he was watching the bond market, but he didn't say that's why he made the decision. So we continue to wonder. All right, thanks, Ben. Appreciate it.
That's fine.
Well, President Trump did blink, pulling back on the most extreme tariffs on every country except for China, on which he imposed those 125% levies. While the markets have reacted enthusiastically, U.S. standing in the world has dramatically shifted under the president's leadership. Let's bring in someone who knows a lot about leadership. That's Bill George. He's former chairman and CEO of Medtronic and executive fellow at Harvard Business School. Bill, you've taught and written for decades about management and leading with conscience and leadership generally. What did you think of the leadership on display today and behind this decision?
We have a president who thrives on chaos, uncertainty, loves to negotiate. He set the bar very high to his favor on negotiating. And he loves power over others. And he loves power over the markets. He just caused the market to swing wildly. And I think he thrives on this kind of chaos. Now, put yourself in a position, I've been with a lot of life science CEOs lately. Put yourself in a position, one of those CEOs who's got a major business globally, big business in the US, China, Europe, all over the world. What's that CEO going to do? And, he doesn't know he can't predict his tariffs. He seen a couple of his competitors go to Trump and offer new factories. He knows a new factory won't be up and running until well after this administration's over. And he's being cut back on his R&D from NIH. And I think what he's going to do is pause. He's not going to make any investments in the United States. until he gets some clarity, because CEOs thrive on exactly the opposite. They want clarity and stability. And so I think that's the dichotomy that's going on right now between the White House and by the way, I think that this president loves tariffs, and I think he always has. I think for the reason I mentioned, gives him power, even if the rest of the world doesn't. Now the big issue here is China, though. Let's not underestimate. It's really a two country real power world, and if we're playing this game with China, and I don't think President Xi can back down, I don't think President Trump's going to back down. So we talk 125%. This is crazy. Now I would point out China's only 13% of their exports go to the United States, so that's only less than 1/7. So they will focus on other countries, and I expect China to draw much closer. They've done it with Africa, they've done it in Latin America. You'll see them draw much closer to Europe and to other, already started with other Asian nations. So long term, this is great damage to the trust people have in the U.S. In effect, we've destroyed 75% of relationship building in 75 days.
Bill, let me ask you, if you were still a CEO, Bill, and you were still running a big company, lots of responsibilities, a lot of employees depending on you, customers depending on you, what would you be doing, Bill? You know, what would be your game plan? What would be your strategy? How would you be trying to navigate this?
I'd be very cautious of my investments. I have some M&A deals I'd like to do. I would hold off on those. I'd put them on hold because people are coming to me running numbers. We can't even run a good set of numbers. I'm going to continue with my R&D and my future investments, but I'm going to hold off any major new factory commitments. I'll continue the ones we've got. And more critically, and no one's talked about this yet, I think I might hold off on new hires. I might even put a considering a hiring freeze, because I know if we go into a recession, which a lot of wise people are talking about, then I want to preserve cash. So that's what I'm doing with capital, is not spending my capital.
Bill,
which is the opposite of what the White House wants.
Right, exactly. You know, it's interesting to hear you say this on a day when we saw stocks behave as they did. And another comment by another Bill caught my eye. Bill Gross, formerly of PIMCO, of course, well-known veteran investor, tweeting today, "My portfolio of defensive stocks is green, so I don't begrudge today's market. But I ask you, would you want to own highly volatile U.S. stocks whose price depends on whether POTUS had a good night's sleep and woke up the next morning to reverse today's policies?" And I guess that would go for not just people who are investing in the market, but to your point, people who are investing in talent, in building factories, in any kind of capex here. So what I'm hearing from you loud and clear is that the decision today does not really change this fundamental conundrum that a lot of investors and CEOs are experiencing.
Absolutely. And I think CEOs widely, I've done a wide range of CEOs, they're going to hold off right now in making any kind of commitments. That's what they're telling me. So I'm not making this up. And by the way, it's interesting that here we have the president responding to Bill Ackman's idea of the 90-day pause. It was Ackman that had that idea. And I think he says he doesn't follow the market. Like, he's following the market all the time. This was clearly a reaction to the market because he knew we could only take so much damage. But it's going to hurt the economy. It's going to hurt new investments. It's going to hurt growth going forward. And yes, it could easily throw us into a recession. And so you have to worry about going there. At least I would, and really worry about a trade war with China, where this is going to end. I would predict right now, this is not going to end well with the Chinese or with the Europeans for that matter. I think the Europeans I'm talking to, we've breached the trust of those Europeans.
Bill, final question. You know, with this Trump tariff pause today, this reversal, I think some are looking at that, some investors, Bill, and they're saying, okay, does that tell us anything about who could be in pole position within this administration? Does that tell us anything who has the president's ear and confidence? Is it Team Bessent or is it Team Navarro? You have a view on that, Bill, or do you think that's overthinking it?
I think it's Team Trump. I think he's going to make his own decisions. He's said that for many, many years. And Bessent, Navarro, these people all have inputs. But I tell you, I think in the end, it's Trump going to decide, and he's going to decide on the spur of the moment. Don't think that this 90-day, as Bessent suggests, was planned, this 90-day pause. There's no way. That was not paused at all. And by the way, on the financial side, The banks are way up today, but the only parts of the bank that are really going to benefit from this are the traders because they like volatility. The M&A parts are not going to benefit. So we'll see. I would not count on this to hold for 90 days. I think we just have to wait and see what's going to happen here. I'm glad he paused because it's a little more calm for a little while, we hope.
Bill, always great to see you and to have you on the show.
Thank you for having me back. Pleasure to be here.
Stick around, much more market domination overtime. That's still to come.
Shorting into this volatile market has been a profitable trade for short sellers. However, as markets rocket higher following President Trump's tariff pause, we're diving into what this means for short trades. Ihor Dusanowski is with us, S3 Partners Head of Predictive Analytics. It is great to see you, especially on a day like this. Ihor, you tell me, this feels to me, today's trade felt to me like there was definitely some squeeziness happening, short squeeze is happening today, but I'm curious what your data is telling you.
Easy come, easy go.
Yeah, I guess so.
We were, the shorts were up $159 billion in P&L, in mark-to-market P&L in April. Looked like there was going to be a little bit of hovering, when people looking to realize some of their profits. Today's trading is just crazy, and I'm not sure how many people were able to cover their trades and save some of their profits. But there definitely was some short covering in the momentum guys and the guys that were getting into hedges.
Ihor, you're a long-time student of the markets. I'm just curious to get more your broad take on what we saw today. I mean, as someone who studied the market a long time, the headlines, the response, the reaction, what did you make of it, Ihor?
Keep your head down, and I mean, I just don't see what the smart bet is right now. What we're seeing is a little bit of deleveraging from some of the hedge funds because there are margin calls when the market takes a downturn. But there's also short selling because they're looking to play the other side of the market. So we're seeing activity on both ends. We're going to see a lot of buy to covers in a lot of names that were moved up high really quick because these were short-term bets.
Where have you been seeing this month so far? Where have you been seeing the biggest increases in short interest in terms of sectors?
Well, first of all, you got ETFs. Guys are using ETFs as hedging strategies. So you've got the SPY, the QQQ, the IWM, and fixed income ones like the TLT, HYG, where instead of going in and having to short a whole basket of names, they're just shorting a large cap ETF. But we're seeing a lot of short selling in financial services, capital goods, software and services. Stocks like Caterpillar, Boeing, Eaton Vance, Vertiv on the capital goods side. Financials, you're seeing Apollo, Coinbase, PayPal, JPM.
I mean, did all this stuff just get blown out today? I mean, everything you're describing, I mean, everything went up today, but everything you're describing is stuff that definitely went up today.
Oh yeah. I mean, everyone who had a pocket full of money is now reaching into a little dusty pocket now with nothing in it. We've got, this happens. I mean, the market is so volatile with Trump, President Trump in the White House. We're seeing these moves up and down on a daily basis. If you're a momentum trader, I mean, you might have a great day, you might have a crappy day. It all depends on what happens with the tariffs and what happens with bonds.
When you said, Ihor, I think you said shorts up 159 billion in April. Can you break that down for us a little bit? Like, what were the most profitable industry groups, sectors to short, and what were the least?
Energy was a really profitable short. Semis was a great short. What else was there? Pharma, biotech was an excellent short. There really were no bad shorts. What happened? We did analysis of the market, and we found that 81% of all stocks that were shorted were profitable. 97% of every dollar shorted was profitable. So I really don't see names on the back end that were in red numbers. In size. This was basically, shooting fish in a barrel.
I know you were looking at the fixed income ETF side of things as well, because the action there was intriguing, puzzling to some. What were you seeing from your end?
Yeah, we saw a large increase in ETF short selling, and I think this is more hedging than anything else. There's a lot of people that want to trade ETFs as a hedge to their portfolio, hedge to Fed moves. But don't have the wherewithal or the the expertise to trade specific bonds. So what they'll do is they'll trade the TLT to get some treasury exposure. On the corporate side, they'll do HYG and LQD, which are the high yield and corporate bonds. And we've seen just $8 billion worth of short selling so far this year, $2.6 billion worth of short selling just in the last 30 days. So there has been a lot of moves. I mean, shorts were down over $800 million, almost $800 million in the first quarter of the year. They're up $1.3 billion in April. Again, today, with rates coming back up to 4.3%, we'll see what happens on the P&L reports tomorrow.
We shall see. Ihor, always good to see you and to have you on the show. Thanks for joining us.
Great to be here. Thank you.
Time now for What to Watch Thursday, April 10th. We're going to start off on the tariff front. Trade war with China is continuing tomorrow. China's 34% tariff on U.S. imports set to take effect tomorrow, making the total 84% for imports from the U.S. President Trump announcing earlier today on Truth Social that the tariff on China is 125% effective immediately.
Also taking a look at the economy. Remember, fresh inflation data coming out in the morning with CPI. That's the Consumer Price Index. Economists forecast total CPI will slow down in March to 0.1%, while core CPI ticks up to 0.3% on a month-over-month basis.
And moving over to the Fed, we're going to be getting a big batch of Fed commentary throughout the day from multiple Fed officials. This is coming after comments earlier today from Richmond Fed President Tom Barkin. Barkin saying that price hikes from tariffs could start as early as June.
And finally, CarMax is reporting earnings tomorrow. The company announcing results for its fourth quarter before the markets open. Investors will listen closely for any new guidance from the used car retailer as it navigates a tariff landscape with rising prices for cars and auto parts. We're going to have more market domination overtime.
More market domination overtime coming right up.
Yeah, stay right here.
Trump's pause on most reciprocal tariffs setting markets soaring. The S&P 500 seeing its best day since 2008. For more on the trading day takeaways, we have Yahoo Finance's very own Josh Schaefer. Josh.
All right, Josh, let's not downplay the drama here. This was one of the craziest days you're probably ever going to see in the stock market, quite frankly, when we take a look at some of these moves. So you had the S&P 500 rise over 9.5% in a single day. You just said it. That is the largest rise we've seen since 2008. The Nasdaq Composite closed up over 12%. Again, that was nearly a 2008 moniker. It actually ended up being its largest rise since 2022. Then you flip over to the Dow. Josh, the Dow gained almost 3,000 points today. I mean, the numbers are just staggering. Of course, the news was Trump announced delaying a slew of tariffs for 90 days. That's where you got this massive pop. Also added more duties to China. Market didn't really seem to care about that. Even if you looked at Chinese stocks like an Alibaba, that stock was still up. Apple performed well as well. I want to just flip to some of those individual movers because look at the Mag 7 today. NVIDIA was up almost 20%. Apple, as I just mentioned, up 15%. Take a look at Tesla, up 23%. But Josh, let's have a little bit of fun here and sort of realize what's going on from the bigger picture, right? Let's go to a 5-day on Tesla. That still doesn't look great, right? So we didn't gain back all of those tariff losses today in some of these bigger names, which I think is important to point out. One more I'll highlight for you. Let's take a look at Apple. We're also going to slap a 5-day on Apple. Apple's still down 11%. You look at the year-to-date on it, stock's off 20%. So it's not like we fixed all of our issues here in one day if you've been someone that's holding Apple since the start of the year, right? We're not back near record highs or really anything like that.
Yeah, and so now the question, was this kind of like a one-day pop or something more sustainable? We did talk to a smart strategist on the show today, and I would say, big picture, she said, listen, you got to let the dust settle after a day like today. But to the extent she said that if we could get back to some cadence where we're less focused on tariffs and politics, and we would be more focused after this on maybe earnings and fundamentals, she sounded more obviously constructive.
Maybe, Josh, at least at minimum, the S&P 500 chart will stop doing this every day, and maybe we'll have a little bit of sustainability to start to understand what the fundamental story looks like right now, because I think that's the looming question, right? You've had this tariff overhang. It's still not gone. We're talking about a 90-day delay. We don't know what's going to happen in 90 days. And it's really hurt consumer and business confidence. So what does that mean moving forward? I don't think the market has that answer right now. And I think to your point, my second takeaway today, the big debate right now is, all right, do I buy the dip still? or am I selling this rip in the S&P 500? I mean, the index is up 10%. It would not be shocking at some point in the next couple of days to see perhaps maybe a big down day as well, right? As you're starting to just see people, all right, I made some profits off a pretty good trade in one day.
And what about all those economists, Josh? You were filling this all week,
Yes.
who were sort of and very smart, sophisticated economists who were all kind of, I mean, really this kind of course of raising the odds, raising the probabilities of a recession, of a contraction. After a day like today, what do you think happens to that research? What do you think happens to those odds?
Yeah, so I think this really explained the chaos of the day. Goldman Sachs, just before 1 o'clock, comes out and says our baseline's now a recession. Now, within that, there was a little subtext of unless the tariffs get rolled back. Well, 30 minutes later, the tariffs got rolled back. Now Goldman Sachs says, maybe not a recession, but the probability is still 45%, what they're tracking. 45% is pretty high, Josh. And I want to highlight another economist and some data he's been looking at. So Neil Dutta over at Renmac, he also called for a recession today. I was speaking with him yesterday about his general outlook. He's sort of been making the point that the economy's been slowing before we talk about tariffs, right? So look at a chart like this. This is the prime age employment. So this is workers age 25 to 54, key part of your workforce. Down 0.5 percentage point over the last 6 months. If I zoomed out on this chart, which I don't have in front of us right now, when the prime age employment drops about 0.5 percentage point, that usually only happens in recession. So you still have a labor market that is definitely slowing. We're waiting for the impacts to come into that data. And it's overall been a low hire, low fire sort of mood, right? So still the question is, how do corporates play out over the next couple months and make management decisions? It's not like we're out of the woods in terms of that recession. So getting back to the equity market side of that, I'm not sure we're really fully done sort of pricing in the impacts of what's already happened and kind of the chaos of the last couple of weeks.
Economists, tough job in the best of circumstances.
It's really hard right now, Josh.
Yikes. Thank you, Joshua. Stick around. Much more market domination overtime still to come. Well, Apple stock regained some of its losses today after the announcement of that 90-day pause on some new tariffs, while the tariff on imports from China to the U.S. has been jacked up to 125%. Joining us now is Bob O'Donnell, Technalysis Research President and Chief Analyst. Bob, it is great to see you. So when we say, Bob, Apple regained some ground, let's put a number on that, Bob, because this stock roared today, Apple, Tim Cook's company, tacked on more than 15% in today's trade, Bob. Try to unpack that to the extent we can ever unpack one day's move. Is that because, Bob, is that your guess that, okay, investors thinking the pressure on China, that is still on. Trump made it clear. He's not happy with Beijing in the least, but the pressure in other parts of the world, the pressure on other parts of Tim Cook's supply chain, like India, like Vietnam, some of that's coming off. Is that what you think investors were reacting to?
Look, honestly, Josh, I feel like it was more just of a release. And we saw the whole market obviously grow, and Apple did a little bit better than the whole market. But I think the vast majority of that positive reaction for Apple was just related to the overall market movements. And here's the problem we still have, right? To your point, yes, Tim Cook has been building out the Apple supply chain, but we still know that India and Vietnam and other parts of Southeast Asia are a tiny fraction of Apple's overall supply. Most of it still comes from China, and that, of course, is now getting even higher tariffs. And of course, we've seen stories about how Apple airlifted, all their expensive devices. They paid extra to get it here to avoid the tariffs. And there were stories that Apple stores over the weekend were crazy. It was like holiday time because people were buying ahead of the tariffs. But that's not going to last, right? That's unfortunately not going to last. And the situation that we've got now is, yes, there's a 90-day pause, but clearly we've entered an era of complete unpredictability. No one really knows what's going to happen. And you've got this overhang. And oh, by the way, even without the overhang, you still have 125% tariffs on China, where most of Apple's goods are coming from.
So if that's true, Bob, and it is, the pressure on China is still on. I mean, Trump made that very clear. Not happy at all. Says they're not being respectful, I think is how he put it. If that's true, and as you point out, China, key link in Apple's supply chain, what, Bob, for the investors who are listening right now, how is that going to ripple through Apple? What are going to be the potential financial impacts? How does Tim Cook actually navigate that?
Well, look, a couple of things, Josh. Let's not forget that hardware is still not all of Apple's business, right? The services business has been the most profitable and the fastest growing part of the Apple business for several years now. And honestly, even if for some God unknown reason, sales of Apple devices stopped tomorrow, you still have over 1 billion installed base devices, and they're buying more and more and more of these services. Now, that's not going to happen, but my point is there's still opportunity for Apple. It's just that, the hardware piece of this story is going to be much more difficult. And, it's the whole notion of how they can uproot their supply chain. I mean, this stuff, for people who know about this kind of stuff, and I've been looking at this a long time, this takes years and years and if not decades, not weeks, not months, nothing like that. So there is no short-term fix for some of these hardware issues. And the crazy thing is, if Trump is really focused on China, then he should really ease up on Vietnam and other parts of Southeast Asia, where not only Apple, but a lot of other tech companies and apparel companies and a lot of companies move their production to avoid being so focused on China. So if some of those things aren't released even more, I would argue, you're actually kind of helping China in a weird way.
What would be the odds, Bob, you would place on Tim Cook being able to secure some type of exemption, some type of tariff carve out? Because it was interesting, Bob, just today, I don't know if you saw Trump talking to reporters, and some reporter asked him directly, hey, Mr. President, would you consider exemptions for American companies? He didn't say no, Bob. He didn't. He said, hey, that's going to be something we might take a look at. And of course, as you know, Cook did secure those exemptions during Trump 1.0.
You're right. Sorry, Josh. You're absolutely right. And that's yet another wild card in this whole equation, right? Because Apple has, they're a poster child for American innovation, and one of the biggest companies in the world. And clearly, Cook has worked to try and engender a good relationship with the Trump administration. And so I think there's going to be a lot of work to be done there. But, unfortunately, right now, again, that's just so unpredictable. And how long does that last? And how does that play out? And what other kind of cards get played to try and use that as a way to try and leverage moving supply chains, without the really accepting the fact that it's going to take a long time? All of those are big questions. But bottom line is, I would not at all be surprised to see a carve out just for Apple, or maybe for Apple and Dell and a couple of other, kind of key name American brands. But it's just really hard to tell.
Bob, for investors who are listening right now, let's say you're an Apple bull, you're an investor. Let's put traders to the side. You're an investor. You stay focused on what, Bob? Aside from the kind of the near-term changes and headlines and drama, you stay focused on that massive installed base, Bob? You stay focused on that Apple Intelligence upgrade cycle?
For sure, you stay. The install base is what gives Apple this enormous advantage over everybody. And so that continues to be a big issue. And they're continuing to build new services. And Apple Intelligence down the road is going to be one of those services from which they're going to generate more revenues. Now, obviously, they took a couple of stumbles. It's hard to do for a lot of reasons, and a lot of companies are facing these issues. But look, down the road, there will be yet a large install base of AI-capable devices, and you're going to be able to run more things on the device. Apple will eventually figure out ways to monetize some of those capabilities. So there's plenty of positive roadmap for Apple. It's just, right now everybody's getting caught up with the tariffs and the manufacturing and the hardware piece of it. But if you're thinking longer term, there's still, plenty of opportunities for Apple. It's not going to be easy, to be clear, but it's not like it's doomsday, right? And again, as I said, even if somehow they stop selling devices, that services opportunity is going to give them some growth opportunities for a long time.
Bob, always great to see you, my friend. Thanks for joining us.
Thanks, Josh.
Stick around. Much more market domination overtime. That's still to come. Breaking news right now. U.S. Steel shares dropped as much as 16% in post-market trading. That's after remarks from President Trump from the Oval Office. Trump said he does not want U.S. Steel to go to Japan, adding, quote, "We love Japan, but U.S. Steel is a very special company." This is coming days after President Trump ordered the Committee on Foreign Investment in the United States to conduct a new review on the proposed acquisition of U.S. Steel, remember, by Japan's Nippon Steel. The review of the acquisition, again, is aimed to assist in determining whether further action in this matter may be appropriate. It's according to a presidential action. Of course, all this coming on about a remarkable day in the markets here after the Trump tariff pause, the Trump tariff reversal. You saw simply incredible moves in your popular averages. You can see here the Dow up nearly 3,000 points. Your broad gauge, the S&P 500 tacked on 9.5%. Your tech-heavy Nasdaq up more than 12%. Why now? Why in this moment? Our reporter Ben Werschel pointing out that Trump did tell reporters he did this move because people were getting, in his words, yippy and afraid. They were getting a little bit yippy, a little bit afraid. He said apparently they're referring to the market unrest that unfolded since his Liberation Day tariff announcement a week ago. But investors clearly, it seems really focused on this 90-day pause. Maybe they're thinking 90 days where countries can come together, discuss, negotiate, maybe even reach some deals. We shall see. That is a wrap on today's Market Domination Overtime. Be sure to come back tomorrow at 3 p.m. Eastern for all of the latest market-moving stories affecting your wallet. Have a great night.